Hi everybody, Thomas at Rebel Income here. Lately I've been putting a lot of focus on the food products industry. That might not sound all that exciting, but in an environment where the market is increasingly risky, I think it makes sense to look for conservative ways to put your money to work for you. I like food product stocks because the demand for their goods remains consistent even when households have to start tightening their budgets. McCormick and Co is a household name. At least I'm willing to bet that you'll find one or more of their spices, seasoning mixes, or condiments in your kitchen pantry. They've been around for more than 100 years, and they occupy a rare place in the market as a dividend aristocrat. Meaning not only that they have a history of dividend payments that stretches back to 1923, but they've also increased their dividend each year for the past 36 years. That's a credit to the strength of their business, which has seen some useful improvements in some important fundamental metrics lately. Let's find out what kind of a value proposition they offer as well. Although the stock is significantly below the 200-day moving average, which we can see with my blue line here that is starting to flatten out, the stock's trend over the last couple of months, really since the beginning of October, has been going up, which we can see with the green line. More recently, the stock has started to hover in a range between about $67 per share on the low end and $70 at the top end, where the stock peaked earlier this month. With the stock currently sitting below that high point, it looks like it could be an opportunity to buy the stock along this nice little short-term upward trend that we have, kind of a buy the dip opportunity, waiting for the stock to push above $70. Technically speaking, that's interesting. It may also be useful for short-term trades. The real question for value investors, of course, is what the current rally means. Has that rally outpaced the bargain proposition for the stock? Does it still represent a useful value? Let's go ahead and take a look at our fundamental numbers and see what we can find. McCormick's free cash flow has seen some useful growth over the last year. We can see that 12 months ago, free cash flow was about $389.5 million, which is a fairly modest number, but increased by almost double to $779.1 million in the last quarter. That's a useful increase, even though the free cash flow yield is still relatively modest at 4.26%. A counter to that increasing free cash flow number is the amount of available cash, which is fairly minimal and has also been declining over the past 12 months from about $334 million a year ago to its current level, a little bit below $155 million. That's not great. It is honestly a little bit of a concern, but it could also simply be reflective of the company's efforts to deal with increasing cost pressures in a high interest rate environment. Even though cash and liquid assets have been declining, long-term debt has improved. We can see that a year ago, long-term debt was $3.6 billion. It increased in the last quarter to about $4.1 billion, but also dropped again in the most recent quarter to a little under $3.4 billion, meaning that the company has liquidated more than $700 million of long-term debt just in the last 3 months. That's a positive overall trend. The company's profitability is also improving, and that's a confirmation indicator for the improving free cash flow. We can see that in the trailing 12-month period, net income was about 9.8% of revenues, which is generally considered to be a good, healthy number for food product stocks. It improved just a little bit to 10.1% in the last quarter. McCormick's dividend isn't necessarily the highest in the food products industry, but it is useful at $1.68 per share. That translates to an annualized dividend yield of 2.46%, which is even more attractive when you put it on top of the stock's value proposition. My valuation analysis puts a fair value target for the stock a little bit above $98 per share. And when you consider that the stock right now is just a little bit above $68, that means that there's almost 44% of upside in the stock price alone. When you add in the 2.5% of dividend yield, you're looking at a potential long-term return in excess of 45%. That's very attractive, especially considering the direction of the stock's current rally. The next question, of course, is to evaluate what the overall upside is in the stock against its overall downside. Let's take a look at support and resistance levels and see what we can find. With the stock currently trailing right along its 20-day moving average, current support looks to be in the neighborhood of about $67.50 per share, which is right around where the 20-day moving average sits right now. Immediate resistance back at the stock's recent pivot high that occurred earlier this month at about $70. Now, if the stock can continue its current upward trend and push above $70, the next question becomes, where is next support likely to be? The stock experienced an interesting gap a couple of months ago on the downward side. We can see that here. This was an overnight gap from about $74 down to about $70 back at the end of September. With the stock starting to approach that range, the easiest way to identify next likely resistance is to look for the last support point that occurred before that gap. It looks like that is at a pivot low that occurred right at around $74. Now, despite the strength of the stock's current upward trend and the expected support that should occur at $67.50, it's also possible that it could break down below that point. So we want to make sure to try to think about where next likely support is going to be. In this case, it looks like the last pivot high, which often acts as a new support point if the stock starts to break down from its current upward trend, looks to be at about $66 per share. That means that in terms of immediate reward to risk, stock is offering about $2.20 of upside against about $1.80 of downside. That's less than the 2-to-1 ratio that we want to look for good near-term trades. That means that McCormick's probably not a good setup right now if you're looking for a short-term trade. However, the profile will change if the stock breaks above $70 per share. In that case, the reward to risk shifts to about $4 of upside between 70 and 74 to less than $1 of downside, with $70 expected at that point to act as new support. Whether you're looking for a short-term trade or you're thinking about McCormick as a possible long-term value-based opportunity, it looks like the best probabilities of success would lie in waiting for the stock to break above $70 per share and extend its current upward trend up until about the $74 range. Altogether then, under those conditions, it's pretty easy to call McCormick a great bargain right now. Thanks everybody, hope this has been useful. If you like my content, please go ahead and subscribe to my channel by clicking on the link shown right here. You can also learn more about my Rebel Income system by checking out this video. If you'd like to subscribe to my Rebel Income reports and trading alerts, you can do that by visiting my Patreon page. The link to that page is shown in the description area for this video. Thanks again, everybody. This is Thomas Moore. Talk to you again soon.